It is that time again. We've got Q&A coming your way. Kris Krohn here on Limitless TV with over 100 videos on real estate investing. And you've got questions, and today you get the answers. First question of the day comes from Michael Levan. He makes it sound unrealistically easy. It's not that easy just to walk into equity. Michael, whatever you want to believe, buddy. I'll tell you right now that if you drop a comment in the link box below, I'm sitting on 3 live deals right now, and guess what all 3 of them have in common? Equity! I kind of cheated though. I made it easy for myself because I built a team over years and spent a lot of money to put them in place so that they can do what they do. So it's easy for me now, but there was a price to pay in learning how to do it. And in the beginning, when you don't have those resources, you got to kind of go and do the longhand version of it. I'm offering everyone today a shortcut. If you want to just take my cheat and walk right into my deals, you can do that. And Michael, if it's really hard for you and you've been struggling and it's unrealistic, then let me give you one of my deals, okay? Next, Joe Silva. So say your tenant ruins the house or loses their job and can't or won't pay the monthly rent. How can you prevent a person getting a person like that? Well, so this is a really fantastic question, Joe. When I go into my nationwide markets, the market has over 300 submarkets. Let's take Orlando for a moment. I'm looking at a picture of the Orlando city map on the wall in front of me. And on this map, it's got this huge area for the county of Kissimmee. Kissimmee is right underneath the Orlando parks. In that demographic, the majority of people that live there all work at Disneyland. The majority of those people make $60,000 a year plus. Those people have a very easy time affording the payments and rent for the houses of that type and style. So the nice thing is Disney is generally very, very secure in their jobs. That's a very high income for the area. And that's only one of the things that I look for in the demographics before evaluating going into a particularly area. So for this particular area, what really works for me in Orlando is that I've got really strong performing job. Phoenix was the same way. Vegas was the same way. So go into a strong marketplace. This is the benefit of going into a city that has millions of people, into an area that has a lot to draw from and has a strong economic pull and really good jobs. There's a lot of areas where you can do real estate where, you know, the economy is definitely not that booming. You've got more urban development. It's kind of a smaller location, lacking population, and you can get yourself in the opposite mess. And so what should you be looking for? You should be looking for a really strong market and a house that is outside the ghetto that's going to perform for you. These videos talk about how you can do that. And of course, my team will set you up with those as well. Stanley Hogue, every house you buy, you use the equity from it to buy another? Ooh, I love this question. Whenever I can, Stanley, I do. While I am in the building phase, most people watching these videos, they're not multimillionaires. And so the question is, especially for those of you that talk about debt and you're like, well, I want to stay out of debt. Okay, we're going to control debt for a short period of time. How do I pay off my houses? Not by paying off the debt. I pay them off by controlling them for a period of time and then releasing them. I buy a house for $100,000 that's worth $150,000. I control it. I make a cash flow. I got tax benefits. And 5 years later, the market's right. I sell it, and I sell it for $170,000. Well, I probably in that 5 or 7 year period of time only paid off $5,000 on the house's loan. Why? Because when I get a loan from the bank, the majority of that just goes to the interest. If I wanted to be serious about paying it off, it would take me 30 years to do that with the bank, or I could put it on a 15-year mortgage and all of a sudden I'm negative cash flow on the property, or I could take the extra cash flow and apply it to the property and see if I can pay it down faster. I'm not trying to pay off the house. In 7 years, I don't want it. You know what happens after a tenant lives in a house for 7 years? You don't want it anymore. So I hold a home for a period of time generally, and then I swap it into something else. That's called pulling the equity from one house into the other. But sometimes you can do it prematurely. So if I get a really good deal on the house and the market's moving, I can refinance some of the equity out of that house and still keep the first one, keep the cash flow, and have the money sitting in a different house also earning me money. Now the same dollar that's sitting here is also sitting where? Here. On this house I'm making 10% per annum, but over here what am I making? I can't calculate it. It's not my money. I mean, it is kind of, it came, but it's sitting in that other house. Oh my gosh, that's like an infinite return. Yeah, I got my money making money for me in multiple places at once. And so when I can borrow from a house while still keeping a 20% position in it, As long as it's a house below the median, I do that all day long. That works. Sometimes houses don't have that extra equity to pull out, and the only way to get the equity out is by selling it. And you know what? There is a life cycle for every house. Right now when you walk in should be your highest position of profits, and then over time you start getting a diminishing return. Again, one of the other reasons why I'm not holding on to that house forever. If I can walk in with a booty, pirate booty, a big pile of equity, and I can transfer that into another home that also has equity, now I'm snowballing equities and cash flows, and that's why I pull money out of one home and put it into another. Great question. Okay, Eden Tan shoots us this video. He must have watched the video where I talk about my very first house because he says, "What a good informative video, sir. After you've paid the $5,000 on the first home, what's the next step? How do you actually pay the bank's loan for the next month?" Friend, if I'm living in the house that's a primary residence, then I got to pay for that. It's either I'm paying for rent or I'm paying my house. And if I pay my house, at least that can go towards equity. When I bought that very first house, I was renting for $400 a month. I got myself into a mortgage that was $800 a month. $800 is way bigger than $400. But because I could rent the basement at first for $550 a month, then what I was actually paying was about $250 a month. So I was instead of throwing money away at rent, I was actually putting it into a house. That was pretty cool. Then I was able to refinance it, lower the rate, and then the entire basement covered my entire mortgage. That was so cool to live for free. So your first step is to make sure you pay your mortgage, just like you would pay rent, except now it's doing more for you. And the second step is what I did later. Because I bought it with the equity, which created that situation for me, I was able a year later to use that equity, tap into it with a refinance, and use it to buy my second home. The second home was so much nicer than my first home, but I wasn't buying it for me and I did never live in it. It was actually almost three times bigger than my first house. It was still bought below the median. I got a crazy deal on it. And that house made me a pile of money because it was more important for my money to work for me than elevating my standard of living. And so keep snowballing your real estate. Buy a smart investment. If you're having trouble finding one, then reach out to me and my team in the comments below and let's hook you up. Brian Nedrovo, yes, but how do you use that money to buy another investment property? As an example, if I got an equity loan for $40,000 and the property's worth $100,000, do I have to apply to another mortgage? And what happens if I can't pay off that equity loan? Okay, this is a really, really good question. I want you to see this math. Brian, thank you for asking this. I got a $40,000 line of equity. That means that I've got $40,000 of equity in a home. And if I pull out this $40,000, then my mortgage will go up. It's like having a mortgage tied to a credit card or a bank account. And so that $40,000 that you borrow, it needs to make sense where you put it. Because if I just put it into a houseboat that costs $100,000 and it has this thing that I can't pay and it doesn't produce cash flow, well, that's just consumer debt. It's not a business. It's not making me money. It's a bad debt. But if I want to pull that $40,000 out and place it in another home, if that home has equity, that then becomes its down payment. That's going to lower its payment. That's going to create a cash flow. And the cash flow between the two homes should be greater than whatever your expenses are. So the other thing is you asked, how do I qualify for a second mortgage? Here's the cool way the math works. Most banks are going to take 70 to 80% of the rent that you're getting on a contract, and they'll apply it towards the debt. So when I bought my first house that had the $800 payment, and then I had the payment drop to $500 a month with the lower interest rate, something cool happened. I went and put a tenant in that home at $1,000 a month. And I wanted to buy something different. And the bank said, oh, okay, but you got this $500 debt. Oh, here's the rent contract. Well, what's 70% of $1,000 a month? $700. 700 is bigger than 500? That means that my DTI, my debt to income ratio, actually went down and my income went up? Yep. Buying my second property made me look even more financially attractive to the bank. But that can only happen if you're buying smart with equity in the right price range. So that's exactly how you do it. Hush puppy. Kris, why single family homes? Hush puppy. Single family homes. Such a good question. Why not multifamily apartments that are valued by their NOI divided by their cap rate? I invest in single family homes too, but all the traditional gurus say invest in multifamilies to scale. You own hundreds of houses around the country. Clearly there's a reason you prefer them over multifamily. Hush puppy, I like your name. There is a reason why I do single family homes over multifamily. First of all, when you get into multifamily, when you look first at triplexes and fourplexes, most of those sell in the market without equity. And if I can buy a home with equity, I would prefer that than a fourplex without equity. Also, have you ever had a bad renter? Well, now imagine a home with 4 bad renters. Fourplex for me, if I can't get the equity, the play doesn't make sense. However, if I have the chance to go in a multifamily with 10, 20, 30, 40, 50 units, I can do that, but now that takes millions of dollars. So some people will go from single family into bigger projects. I do this from time to time. But more single family homes does not equal harder to manage than one single project. I employ property managers. I employ a tax accountant. Guess what? It's honestly not much work doing one compared to the other. And so it's really a matter of what's working for you. If single families is tearing it up for you, then do it and do it more. Never leave what's working for an unknown of what may not work. You always want to go from what's working to something better. And it's good if it looks better on paper, but it's also really important, hush puppy, to check with someone else with a bigger knowledge bank on that particular deal and have them review it and tell you about maybe some of the pitfalls and trial and error, or higher taxes, or higher property management fees, or some of the things that you just may not be thinking about before you make a change in strategy, so you can walk in with as much knowledge as possible. But for the most part, an apartment complex for 100 people or 100 single family homes, for me, not a lot of work difference, and 100 homes are diversified. That one project is not. Those are just a couple of the reasons. Okay, the last question that we have for today is coming to us from Philip Sophia. Thanks, Kris. Quite an appropriate video in the situation I'm in. What are your thoughts on investing in gold? I really like this one. This is a good question. Most people that I know that do precious metals are kind of preparing for end of the world. When you take a look at the investment of gold, again, I don't buy gold with equity, and it's speculative. What does speculative mean? It means that I'm a gambler. It means that I'm going to Vegas. And friends, don't ever invite me to go to Vegas with you. I'm just telling you right now, I suck at gambling. Like, if I brought money, I'd probably lose all of it. I'm sure no one's ever done that before, but put me in real estate, partner up with me, put me at your side, and guess what? It's gonna be like going to Vegas with a winner. I know how to play those high stakes game with a lot of safety. So let's compare that out, because this is a really good question, Philip. Right now, if I invest in gold, I call it speculative because, great, I bought $1,000 worth of gold. Now what? Uh-oh, the value of gold went up 100%. Yay, I made money. Uh-oh, gold went down 20%. Oh, I got no control. And I do own a physical property. I do like that I can touch and hold the gold. What I don't like is that I'm not walking in with equity, and I'm just hoping that the market goes up. In real estate, I'm not hoping the market goes up. I bought the way Warren Buffett talks about. I bought with equity. I bought with instant equity. I bought below market. I got my cash flow. Here's my definition of an investment. This will help you. Is what you're gonna buy gonna pay you every month? Gold does not make babies. It will not pay you every month. So you know what? It's not an investment. It's speculative. And speculative investments are things that truly I try to stay away from, or only put a teensy-weensy little bit of my money in. I love being able to control my assets as much as I can, and real estate affords so much more opportunity for me than that. I'm gonna take one more question. I sold my home. My real estate agent charged me 6%, and she was a friend. Did I get ripped off? Friend, you didn't get ripped off. That's what realtors do. If they help you buy and sell the home, the same home, they're gonna earn 3% on each side for a total of 6%. Anytime I have a listing with an agent and they're gonna do both sides, I ask them to do both sides at a reduced rate so that we're not really getting into a greed factor, and to help a brother out. So the realtor that right now has been selling off a dozen of my homes every other month, I've asked them to do it for 1.5% instead of 3%, but 6% is otherwise considered standard. I do like to get a deal, and sometimes I get what I want, and that often happens with realtors. Friends, thanks so much for joining us today. Fantastic questions. Keep them coming in. Wow, that was a lot of questions. Good work. Put me to work again. You know how you do that? When you watch these videos, I want you to comment below, make a lot more questions, and then I'll shoot more videos like this, because personally, I hope we get to meet in person face-to-face at one of my 3-day real estate training events called Limitless Wealth Intensive. But you know what? Other than that, keep shooting the questions and let me keep providing as much helpful response as possible to help you successfully invest in real estate.